Hello and welcome to today's episode of Nucleus Investment Insights. The question we're going to ask today is, what's the one thing that could kill inflation? On the agenda, we're going to look at wage growth hot zones, mild zones, and cold zones around the world. Then we'll look at structural changes in markets after COVID, as there was a move away from services to manufacturing, and now it's going back the other way. And lastly, we'll look at the locked up employees from these structural changes. As always, we have Damien Klassen, who is Nucleus Wealth's co-founder and chief investment officer. For those of you that don't know, prior to starting Nucleus Wealth, Damien spent 26 years as a portfolio manager and an equity analyst. He's an expert in the field of financial modeling with extensive experience in research procedures for equities, structured products, hybrids, and alternative assets. He's also a founding member of Aegis Equities and has lectured at the Securities Institute, Finzia, and Kaplan for 12 years. So, Damo, welcome.
Hi, Sam. How you going?
Very good, thanks. It's good to be back in Melbourne for a while.
Yes. Good to see you. And we'll turn the weather on for a change.
Indeed. So my name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth, and I'll be hosting the show today. I just want to let everyone know that last night we held our first live in-person event since COVID in our Melbourne office. It's called Meet the Managers, and we're going to be coming to a capital city near you soon. So this is very different than our weekly podcasts. We cover many different aspects of Nucleus Wealth, the products we offer, the services we offer, and the innovations that are coming. And it's an opportunity to meet the team and ask questions in person. So we're going to be sending something out in our weekly newsletter tomorrow for anyone that wants to express interest in coming to one of these events. So if you haven't already subscribed, please subscribe at nucleuswealth.com. There's a button on the homepage there, and we'd love to see you at one of these events and meet you in person. So just a quick housekeeping reminder before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform, as our show's available on all the majors. And you can also ask any questions for those of you asking live, and we'll do our best to answer them during the show. As always, if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way, Damo, I'll hand it over to you to lead us away.
Thanks, Sam. So I thought I'd start with just a quick sort of run through the globe, and actually, but probably to take one step back. So what we're really focused on in terms of inflation is looking at wage growth, because that's the one place where we could continue to see. That's the thing. If we're wrong in terms of our view that the rising rates will cause recessions and drop back wages, and we won't be in this wage price spiral, is where we're going to see it is in the wage side. So we're quite focused in terms of looking at wages in different countries and different areas and trying to work out, could we be wrong in terms of our view, so that's what I thought I'd do, is run through each of the countries first, and then some of what we're seeing at the margins in these, and some of the things that suggest, where we need to be looking to see if we are wrong, and ones that suggest we're right. So in terms of the hot zones, you've got to start at the US. Wage growth certainly is strong in the US. I've got a chart up just sort of showing the Atlanta Fed wage growth tracker, and that's sort of showing well over 6% and starting to fall a little bit, but in the end it's you're very, very strong in terms of wages there, and if we continue to see 6% plus or even 5% plus wage growth in the US, then then inflation's with us for a while. On the other side, of that chart, we've also got the hourly earnings. You can see that's a fair bit lower, and so there is those sort of questions within the hourly earning rate versus picking up extra hours and working overtime and things like that. But there's no way to sort of suggest that anything in the current numbers is weak. We'll look at some of the forward numbers in a minute, but certainly the US wages are running hot. You switch then to the UK and a very similar scenario in terms of wage growth in the UK. You're running at 6% ish, and certainly having come back a little bit, but again on the rise. And so not too many ways to turn the UK into a case for lower wages. Then that's so they're the two main hot zones. Then you start moving into some of the milder zones. If you look at Europe, so wage growth is about 4%. If you look at the euro area, it's hasn't spent a lot of time at higher levels. So and I guess the most recent quarter fell back a little bit, but I guess there's still question marks over. You're certainly not seeing that sort of 5%, 5 and 6% that we're seeing in the US and elsewhere. And then if you dig into the actual countries within Europe, I've got another slide up that sort of shows all the different countries sort of lined up, and you can see that there's a whole bunch of countries, and mostly the developed countries that sit well below average. So Denmark, Finland, Netherlands, Spain, France, Sweden, Italy, all at sort of 2.5% or below. On the higher side, you can see Germany is probably the biggest country that's on the higher side. Some of the growth in Germany probably isn't as much of a concern in that it's been a lot of one-off bonuses that you've seen in terms of rather than sort of giving wage rises, they've been giving these wage bonuses to help ease cost of living issues, but they're not like they haven't been like a fixed number in terms of it's not something that you then expected to pay, or not necessarily expected to pay again the next year. So you might have had a worker on 60,000 euros a year, and they've just been given a $4,000 one-off sort of bonus from the German employer, but they're still on that $60,000 a year and sort of going from there. And then once you get up to and then over to the right of the chart are all the sort of the emerging markets, I guess, in terms of that. So when you're looking at developed markets within Europe, we are still looking at quite low wage growth within that group.
So, Damien, just you mentioned there, if wages stay high, inflation's likely to stay with us. It's obviously running hot in the US and UK, not so much so in Europe. Like, how big an impact does Europe have, and what for global inflation? How influential is the US?
Look, US is very influential, but I guess what I'm looking at here is there's an argument that says that inflation there's this latent inflation sitting around everywhere, that central banks have been spending money for a decade now or more in terms of pumping more money in and more liquidity into it, and there's all this latent inflation that's hiding, and it's about to come out. It's been waiting to come out. And a lot of those people are then saying, right, this inflation burst that we've seen. It's not so much about the supply chain. It's not so much about pandemic related shortages and things like that. It's actually the chickens coming home to roost from all the monetary spending that's been happening over the last decade and a half. And now we're into this this inflationary burst that's going to stay with us for a long time. And so I think that there's obviously no argument about whether inflation's here or not. Now it's just a question about saying, well, what's the cause of it? Is it supply based, and then morphing, not morphing completely, but morphing slightly into now then Russia attacks the Ukraine, and we've got all these further supply disruptions, plus we've got these energy costs that are causing this this burst of inflation, and then as that sort of washes through, it'll all fade away, and we've got the Fed raising rates, and that's going to squash demand, and we could see deflation on the other side of it. That's sort of our take of it. The people who are suggesting the inflation is here to stay, their argument tends to be that all that spending and that we're just going to see this wage price spiral, or we're going to see so wage inflation will then lead to more inflation from companies, which then leads to more wage inflation, and inflation just stays high. is the argument. So that's what I guess we're sort of testing our theory about the deflation as all these things fade through and higher interest rates bite and demand gets hit against this view of and so I guess if we saw consistent wage growth right across the world, that would certainly be a dent in our argument and something we'd really need to think about. And I guess that's where we're coming back to, is saying, well, we can't see. Well, we've just done the hot and some of the mild zones, and we're not seeing that consistent inflation right across the world. So consistent, wage growth right across the world.
Okay, that's good clarification. Thanks for that.
And then you look at Canada, and again, Canada, coin tosses whether it went into a mild zone or a cold zone. It's sort of sitting about 3% wage inflation now, which is pretty much where it's at, from 2018 to 2020. It's actually a little bit lower. I think 2018 to 2020 it was probably closer to 4% for a lot of Canada. So mild there. It's not showing massive signs of a wages breakout, and the latest sort of numbers have been softening a little bit there. Then you look at Japan, and Japan is certainly very cold, so under 2%. They sort of touched off 2% a little bit earlier, so 2% is their inflation target, and if you're getting a bit of productivity growth and things like that, most countries really would be expecting to run wages around about 3 to 4%, which would give them sort of 2-ish% inflation plus a bit of plus some productivity growth to sort of bring your wages. So Japan very weak. Australia then very weak as well. So in terms of I've actually shown it a little bit differently here, just looking at the different some of the different sectors, and we've got this in the RBA inflation target. So you can see some sectors have been above 3%. So real estate, construction, admin, support are all up there, but the vast majority of sectors are below the sort of below 2.5% in terms of the average wage growth. And so below sort of 2.8% or whatever the average wage growth at the moment is in Australia. So Australian wage growth is sort of targeted to be 3 to 4% because we have a slightly higher inflation target. But the net effect really is that it's running well below inflation, but we really haven't seen the type of wage growth pickup that the RBA was suggesting for the last sort of year or two. Oh, maybe the last 9 months as they've been raising rates. They've been talking about their industry liaisons talking about this wages breakout, and now we've got a flood. And this was sort of before we had a lot more immigration, and now we're seeing another flood of immigration. And so there's a strong chance in Australia that'll actually put a lid on whatever wage growth we might have started to see. Will be restricted by both rising interest rates and more people flooding the market. So I just want to give a longer term view of this sort of real unit labor costs, and that's this next chart. And what this is this also impacts. So this is related to inflation as well, and it's also impacted by productivity. And so you would expect that unit labor costs wouldn't be rising sort of rapidly. If you saw them flat, would sort of be saying that okay, they're keeping pace with keeping pace with inflation at least, and that there's some productivity gains, and a lot of the gains are sort of ending up with the worker. Whereas this is really telling you the opposite. Is it's telling you, well, they're not keeping up with inflation, and then the productivity gains are ending up with businesses, not workers, and which has been pretty much not a surprise to most people who've sort of been following what we've been talking about is that real wages in Australia have very much struggled, and that this latest inflation burst that hasn't flown through to wages is not helping the Australian consumer or the average Australian consumer. So that's that's sort of the quick fly around the world. Australia and Japan are cold on inflation. Europe, pick your country, but there's a number of countries in there you'd say are cold. On average, you'd call it mild. Canada on the mild point as well, and then at the running hot is UK and Europe. So there's not like a consistent theme there where wages running hot in all countries.
Damo, we've got a couple of questions that have come through. So Samuel Hawks, he's asking, he said he saw a comment around a price spiral, but unlike this time, it's driven by wages, it's driven by corporate profits.
Yeah.
Is there such a thing as a profit-driven price spiral?
Companies would love if there be a profit-driven price spiral, and I think they're trying it. They've certainly been trying it on recently. So I think the level of inflation we've seen has given a lot of companies the cover to raise prices, because even if you're not affected by even if you're not really affected by inflation, and you've got a bit of pricing power, you've got an argument to say, oh, look, sorry guys, got to put my prices up because you've heard about all that inflation and we're suffering as well. Yeah. And so so there's some of that, but the other part is that so as we can see, well, certainly in Australia, you've got wages running at 2.8% or whatever it was, and inflation running at 6%. So if you're a company that's put its prices up by 6% and complaining about having to pay your wages 3% more, well, you've actually just expanded your margins. So which is largely what's happened. Profits have actually been really good for companies. So so that's started, and so now you say, well, can that turn into a spiral where now we need to raise wages more, and wages need to go up again by 3 or 4% next year, and companies will raise their prices by 6% and keep that going. That becomes more difficult. So, and the reason why that becomes more difficult is because of basically the profit motive. Is that we've already seen in something like the transport costs. That we had that massive boom in terms of transport costs. That sending a container from the US went from China to the US went from sort of less than $2,000 a container, to $12,000 or $13,000 a container. It's back down to sort of three, getting closer to 2 now as well, back to sort of older levels. And that's just because there's extra capacity came on. Companies got more efficient at what they're doing, and that's getting competed away. So in sort of sectors where you're exposed to competition, it is likely that companies they're going to be overstocked, and they're going to start competing on price. And but if you can get in a sort of cozy, duopoly or oligopoly or something where companies can sort of restrain what they're doing, and sort of they can all stay together and nobody really pushes through price rises or price cuts or anything like that, then maybe they can keep the profits high. But I think as a general rule, capitalism sort of steps in to save the day, and so a wage profit spiral in my view is unlikely in most sectors.
Excellent. Okay, I hope that answers your question, Samuel. And we've got another question from Jack Isherwood. He says he's interested in your thoughts about the inflationary environment, about how the inflationary environment will impact the transition away from fossil fuels, and how this transition may also impact the inflationary environment.
Yeah, look, interesting question. And that's, over the next sort of 10 years, I think there's, if you're if you've got views that you're supportive of climate change initiatives, and you want to see a transition to a renewable economy, I think you'll see that this push in prices will really drive a pretty solid trend away to renewables. So when we run our costs, and we usually there's a couple of posts we've done on our site that's sort of showing the cost of solar plus battery, which we sort of treat as our killer app in terms of, if you can get a solar panels plus you can get a batteries working at a reasonable price, then that's sort of your upper bound for energy costs. And so the problem with that is that those prices have been falling for a long time, but they've actually started to rise over the last sort of 6 months or so as lithium prices have skyrocketed, plus just a demand for chips, and then actually this huge demand for renewables from Europe now as they want to transition away from Russian gas. So when you look at the sort of numbers coming out of it, if you're talking about cents per kilowatt hour, what we're looking at for solar is sort of there in the sort of 2 to 3 cent range. If you look at a gas-fired plant, the underlying costs are sort of that 2 to 3 cents, but then you get the power costs that sort of sits on top of that, and that power cost is the one that's really doubled and tripled, and more, up to 10 times in Europe. And so all of a sudden, solar plus battery becomes so much more attractive in terms of it's so much cheaper, even with the latest price rises, just because gas price has risen so much. So yeah, absolutely, I think there'll be a transition away. That may mean some higher costs for some of these things in the short term, but they're on a sort of technology curve. They're not on a scarcity curve. And so, as long as they're on a technology curve, you'll continue to see those prices, at worst sort of flatten out and more likely to keep falling as now it's a demand versus supply in terms of Europe urgently wants to get off Russian gas. And so it's pushing the price of, solar panels and things like that up, because they're just like, yes, we'll take them at whatever price. But as the production comes on, and the production is not particularly difficult for those, it is pretty scalable. That production is that we think we'll see those prices come back down again. And so so I think there's a short term, we'll call it 1 to 3 years. There's probably not a lot of movement in solar prices, and they probably might even be going up. Solar plus battery prices might even be going up over that time period. But you're going to see some pretty rapid changes after that, as all this extra capacity comes on, and that's really going to put a lid on these prices. So longer term, I think it's a huge win. Short term, it's going to be a loss.
Okay, and what I'll do is I'll post that article in the show notes after the show. So if anyone wants to read about that in more depth, there's lots of good information there. So you can get that at nucleuswealth.com/webinars. We'll upload all these slides in the show notes. So feel free to have a look at them there. Yeah,
and I run that costings, roughly once a year towards the end of the year. There's a few sort of things come out from a few different sources that we get our data from for the prices, and so we'll update that shortly. But it's the real key message is that the prices you're looking at now for gas, the price you're looking at for coal, just mean that renewables suddenly look, on a relative basis, even if their own prices have gone up a little bit, look just way more attractive. And I suppose as well, you'd probably say as well, nuclear looks more attractive. There's obviously an argument over whether there's what will happen from a social perspective in terms of nuclear, but certainly, nuclear looks more attractive as well on a similar basis. Cool. So moving into some of what we're seeing in terms of the US, because that's probably the key part, is that we're looking at the hottest areas and saying, will they continue, or are they going to pull back? If you look at the survey data, the surveys are starting to weaken quite substantially. So I've got a chart up just showing the Atlanta Fed nominal wage growth, that same chart I had from before. And then comparing that to a small business compensation plans for the next 3 months. And so basically what that is they ask a survey of all these small businesses. What are you going to, how much are you going to pay your employees over the next 3 months? And they always say, more or less or the same. And then, and then you compare that to what's actually happened. And they've shifted this. So they shifted the survey forward 6 months. And you can see that that's falling pretty sharply. So there's a pretty good correlation first between the two. So we had a spike in the small business, how much they were planning on paying people, and sure enough, wages spiked. and now that's falling away quite quickly. It's reached similar levels to where it was pre-pandemic. And the question is, will it keep falling, or is this is going to reach a new level where it's at? My guess is that given the way the Fed's raising rates and other central banks are raising rates, that this is one of the key things that we really haven't seen the effect of the current rate rises so far, and we've already seen wages fall. By the time they're finished, wages will be a fair bit lower, I think you'll find. So that's sort of one positive one suggestion that wage growth isn't going to be as persistent. The other one is another survey, which is you're asking larger companies and the CFOs over the next 12 months, what are they expecting in terms of paying wages, more or less, and that's now that sort of rose to 80% of a few months ago. 80% of CFOs were expecting to pay their employees more, and now it's over the next 12 months, and now it's down to 40% of CFOs expecting to pay their clients more, and 40% basically the level we were at between the 2014 to 2019 sort of range. So it's back very much to a normal range. So small companies, suggestions are that their wages are probably still towards the upper end of recent ones, but falling, and large companies are suggesting that we're back to normal in terms of the next 12 months. The other thing then, and this is again digging into this US, given that's one of the hottest area, and just sort of want to make sure that what else is going on that we could be getting wrong in terms of that. What else could sort of drive wages higher? The other one is this chart called a Beveridge Curve. And what this looks at is it looks at the unemployment rate versus the number of job openings. And you'd expect to see a relationship. So as the number of job openings rises, so more and more ads are out there, then the unemployment rate falls. So it gets harder and harder to find workers, and so you got to put out more job ads to find. You can't just whereas when there's lots of unemployment, you don't have to put out as many job ads, because you can just ask your existing staff, do you know anyone that wants a job? And and they've all got friends and relatives and all that, so you don't even need to place a job. Whereas when unemployment's low, then you need to start searching a bit harder to find your employees. And so there's this relationship between them, and each of these different colors sort of shows different periods. And what it seems like is you go through these structural changes. So there's sort of this red line, for example, which was December 2001 to 2007. And that's all very low on this chart, and it's sort of this relationship between unemployment and job openings. And then you have the financial crisis hits, and we jump to this grey line, which is like a step across to the right. And the reasoning for this is that you've had this structural change in terms of a whole bunch of people have actually left the industry. They've been fired, they've retired early, and things like that. And so now structurally, it actually just becomes harder to find employees for a while. And then eventually that line, so that line sort of moves up to the right. So it starts at the bottom right, and then gradually moves its way up left till it hits the top of the chart. And then it comes, then you go back to that. Eventually, it was meant to get back to that old sort of range that it sort of sat in right at the bottom. But then we had the pandemic, and now we're on this sort of new range, way further out to the right than what we ever used to be. And so what we've seen there is that it looks like we've sort of reached the end of that now, where the job openings are starting to fall, but unemployment really isn't changing a lot. So the last few months we've been right at the far left of that, where job openings are falling, unemployment really hasn't been changing much, and part of that is coming onto this next chart, is sort of showing, are we reaching more of a normal sort of job market in terms of that perspective? And what I'm showing on this one is just all the different sectors, a similar type of graph, but it's broken up each different sector, and it's saying, well, what's the average growth in wages been versus the number of job openings? And the bottom chart shows March, so 6 months ago, and you can see that the line of sort of best fit between those sectors, where the sector furthest to the right had almost 10% of the sector as job openings, and they were growing wages at sort of 12%. I think that's the leisure industry. and then all the way back down to the sectors with the least job openings are growing wages the least, and the line's relatively steep. But over the last sort of 6 months, we've seen that line gradually flattening. So even though some of the sectors, and it's still that hospitality sector is far right, is that it's the wage growth has started to fall, even though the job openings hasn't fallen that much. And so the idea here is, look, a shortage is actually, the shortages are, even though that doesn't look like it as much from the number of job openings, they are being filled, and the wage growth just isn't the same as what it was. There's not as much of an effect as what it was at the start of the year. And part of the reasoning for this is coming back to, I spoke a little bit about participation. So if you look at the number of people between 25 and 55 who are working in the workforce, that sort of hit 83% ish just before the pandemic, crashed to 80%, and now it's pretty close to, I think it's 82.5 or something like that. It's getting really close to where it was pre-pandemic. So that's sort of normalized the number of people working in it. What hasn't normalized is your 55 and olders, and so that was sort of 40% of 55 and olders were working, and that fell in the pandemic back to sort of 38.5, and it really hasn't changed much over the last couple of years. And so that's the part where people have left the workforce and are just not coming back. And so the question there is, will the higher wages get them back? Will it just be a matter of time of, okay, those, your 65-year-old has left, but there's another 65-year-old gradually coming through, and you just got to wait for the next cohort of people to start filling that age group out. Very hard to tell, but I guess there's certainly it seems that those older people who have left the workforce are probably not coming back, which is typical of recessions.
Yeah, and Damo, do you think that's one of the primary reasons why wages in the US have been going up? Because there's just these older people, they've gone and they're not coming back, or there are more factors at play?
Well, I think there are more factors at play. I think that's one of them, though. So that's one where the people have left, as you said, and they're not coming back, and so the employers are like, well, what if I gave you an extra $1 an hour, and some, you'll get some of them come back, and then others will go, no, that's fine, I'm good where I am, and so. And maybe there's some still, there could still be pandemic fears in terms of, or sickness fears in terms of people that have decided, well, I don't really want to go back to the workforce because I am 60, 63 or 64 and I don't want to get vaccinated or whatever it is, and I don't want to expose myself. And so, or even if you are vaccinated and you don't want to expose yourself, like there is that element, I think, of in that older age group that, and we're not talking huge numbers, like, this is only sort of 1% or 2% of the workforce. So it's not like there's a massive amount, but it's enough that it can affect the overall unemployment rates and things like that in a meaningful way. So it's not that much in terms of you don't need, I guess it's not like you need to say, oh, well, if I surveyed, 100 of these older workers, 50 of them are staying at home or whatever. It's not. It's only 1 or 2 of them are actually deciding, no, I'm not going to go out. And so the other thing that can affect this, obviously, is, there are people with long COVID. There's some of the other factors is that I do think you've seen in terms of sickness and the average number of people away for has probably increased, and that does seem to show up in some of the numbers. In that it looks as if say it's Woolworths you're talking about, is that they've got a certain number of casual work staff, and at any one point in time, 5 years ago, someone would go, "Oh, I think I've got the flu," and they'd go, "Okay, fine, I'll see you in a day or two when you're feeling better," and that's what would happen. Whereas, over the last couple of years, it's been, well, got the flu. It might be COVID. It's not see you in a day or two. It's like see you in a week or 10 days or whatever the quarantine period is. And in the meantime, they need to get another staff member to come in and fill that shift. Now, if they're casual, which a lot of these ones are, it doesn't actually make much difference at all to the company. The company hasn't really changed its work, but there are now, they do have a bigger workforce, more people employed at Woolworths. It's just that at any one point in time, they might be doing fewer hours. and that sort of showed up in some of these stats in terms of the dollars per hour versus the number of hours worked and sort of issues with that.
Okay.
So that's one reason. The other reason for some wage growth is this idea about you've gone from services to goods and back and forth. So the idea is pandemic hits. I think I've written the headline the wrong way there. So your airline hostess or your waiter after the pandemic hits loses their job, and your airline hostess gets an admin role in a warehouse or a factory, and and maybe your waiter gets a job driving forklifts or whatever it is. So they've switched industries. Now we get and as goods demand sort of picks up, so all this goods demand picks up, and they now have new jobs. Now the airline reopens and starts running more routes, and the restaurant reopens, and they want to get their workers back. And so then they've had to go out and basically offer more money to get them back. And that's really what we've seen at the bottom of that chart. You can see this chart, which is sort of showing a sector by sector look at the US, is that leisure and hospitality has been one of the sectors that's really been driving the wage growth. So there's sort of almost 9% wage growth over the last 12 months, and still running quite hot at sort of still running at sort of 5% annualized rate over the last little while. But it is obviously come back a long way from there. And so and also your workers have just got they've worked out that their job is not secure as well as they thought it might be. So if you were sent home from from your job as a chef with a minute's notice and no no sick pay, and relying on government support to get through the pandemic, then there's a lot of people who will rethink about, do I want to go back to that industry, or do I want to try and find myself a job where I can't get sent home with a moment's notice, or if I do, I can work from home, or I can so I think there's a whole thought around job conditions there that's really causing some structural issues, I guess, in terms of them trying to get the workers back. So yes, that's another factor I think has been affecting it. Another one I've got is this idea of is there a base of employees that are sort of, I guess, not do. I don't know whether not doing anything is the right way to put it, but certainly underutilized. And I'll use an example of say you've got a gym in the city, or a restaurant in the city, in a CBD area that used to run at 80% capacity, and for the last few years it's been running at 40% capacity. And but you got a bunch of government handouts, and so it stayed alive because there's all these been government handouts and transfers and job keepers and all that type of stuff like that. And so now it's a question for the owner about sitting there and saying, when do I pull the pin? So I'm losing money on this thing. I'm not making enough. I've got these employees they're effectively underutilized, sort of sitting there. At some stage, I've got to pull that pin and release that employee back to go work at another gym, maybe suburban gym that is actually busier, or another city gym that, there's two gyms and one closes down, and, now the other one's actually got enough people, but, and the trainers are more, what do you call it? Are more utilized, and similar with restaurants. And so there's that question about, is there still some employees left that are sort of a factor of the savings rates and sort of haven't yet been released to the economy, and when do those start to fold? So I think there's a whole bunch of those reasons. I think unionization is another big factor that, a reason why we're not going to see as much in the way of wage growth. The work from anywhere sort of structural change has helped in terms of workers can move to different cities and work from, say, lower cost regions, and might be happier to take lower wages to do that. But it also opens up that it also opens up foreign workers to foreign service workers to start competing with domestic workers. So in pre-pandemic, it would be pretty typical. Most businesses would have wanted everyone in the office. Post-pandemic, it's been proven to the employers have proven that people can work from anywhere. In a lot of service jobs and knowledge workers can work from anywhere, but that potentially then puts a bit of a restraint on prices as well, in terms of that can we get people from from emerging markets to do the jobs at a much lower cost. So net, I guess as I look through all these sort of wage figures, what it comes back to for me as well. First of all, it's not pervasive in terms of the wage growth is not, in every country we're seeing sort of a similar factor. Whereas inflation, yes, inflation, we're seeing at least some inflation in most countries. China and Japan are probably the big exceptions, but most countries are seeing quite hot inflation. On the flip side, most countries are not seeing this high wage growth. And so, from my view, that's sort of a sign that we're probably on the right path to saying that, yep, we're not going to see a wage growth spiral. You can never say never on these things, and then we need to keep looking and searching and making sure that what we're doing is right. But I think the evidence we're seeing in the US job market that wage growth is slowing and returning to more normal levels, plus the fact that it hasn't been pervasive across other countries, is enough for us to say that, well, we still think we're on the right path, that we're not going to see a wage sort of price spiral. There could, on the other side, you could see, there's other factors that could cause inflation to keep going. But on the wage front, which is the most likely candidate for us being wrong, we're not really seeing any signs that that wage growth is going to stay here for a considerable period of time.
Okay, nice one, Damo. Okay, so now we have our question of the week. This is for viewers to have some discussion in the comment section over the coming days. So the question for this week is a wage growth breakout imminent? So feel free to post your thoughts, engage with us and some of the other viewers over the coming days. So that almost wraps us up. But just before we go, Damien, I'd just like to maybe let viewers know a little bit more about what they could expect with Meet the Managers. So do you want to give a bit of an overview about what we talked about last night?
Yeah, sure. The other thing we did go into a lot of detail on is some of the longer term playbooks. So we always speak week to week about where we are in terms of where we are from an investment perspective and what we're seeing and how we're looking. It's often quite imminent or quite short term in terms of where we're looking. What we really focused on with that longer term playbook about, okay, where's the cycle? Where are we at in the cycle? Where should you be looking? What are the types of things you need to focus on over the next sort of 6 to 12 months in terms of positioning your cycle positioning your portfolio for the next for the current change in cycle and what you can expect next. And so, yeah, very much sort of that longer term view as opposed to the week to week. You get that the week to week stuff here every week. And I'll look at that.
Excellent. Okay, so that almost wraps us up. So Damo, thanks again for putting the show on and sharing all your expert insights.
Thanks, Sam.
Excellent. So we do welcome your feedback on the podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and you can book a call with me. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, would really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media.